Welcome to the Evergreen Wealth Solutions Outlook and Positioning video for September 2023. I will be your host, Derek Varner, a member of the investment team. Year-to-date performance has been strong for large U.S. companies, especially in the technology sector. Despite the rally, many parts of the market appear to offer relative value, such as small U.S. companies, dividend stocks, and foreign companies. Stable economic data has surprised economists and market forecasters who were calling for a 2023 recession that never materialized. The market narrative now seems to have shifted toward the possibility of a no recession scenario. However, we believe that a recession is still very possible in 2024 and are positioning portfolios accordingly. Market leadership this year has been attributed to Apple, Microsoft, Amazon, and NVIDIA. Companies like this, large U.S. technology companies, which have helped the market, the S&P 500 and the NASDAQ power higher. However, other parts of the market, like small U.S. companies, which we say small, but these are oftentimes still large household names like Goodyear Tire and restaurants like the Cheesecake Factory, have not participated fully in the rally. And big dividend-paying companies like Ford, Exxon, Verizon, and IBM as examples, which pay 5 to 7% dividends, have not participated in the rally either, as income-oriented investors have many more places to potentially put their capital in a higher interest rate environment. Apple Computer, as an example, now has a market cap or a size of its shares collectively in the market of $3 trillion. By comparison, the Russell 2000, which is the smallest 2,000 publicly traded U.S. companies, has a collective market cap of less than $3 trillion. So Apple has one company has a larger value in the market than the 2,000 smallest traded publicly traded U.S. companies, which includes, again, household names like Goodyear, restaurants, airlines, etc. So this is one area of caution for us, that we see a lot of value being ascribed to large U.S. technology companies, and we're increasingly looking to other areas for value for the future. The stock market and the economy are very related, but they are not the same thing. The stock market tends to be made up of our collective expectations around the future economic, the direction of the economic cycle, as well as the expectations for the profitability of underlying companies within the market. So they tend to move similarly, but in different at different time periods. Stocks sold off in 2022 in preparation for a recession that never materialized. The S&P 500 has begun to recover and is now within just 5 to 10% of its all-time high. We believe that there is still a very, very real potential for a recession, which we'll talk about why in a moment, in 2024. So we believe that when we look at this gold line of where we may be in the economic cycle, and this shaded area representing a recession, we believe we may be heading toward a recession. However, the S&P 500 is trading like we've already moved beyond the recession, and that is in a rearview mirror. So this gap in expectations may create volatility later in 2023 and in 2024, as we believe investors may need to realign their expectations around the health of the U.S. economy. Shown a different way, we see a significant amount of enthusiasm for stocks today. So if you remember the great Warren Buffett quote, "Be greedy when others are fearful, and fearful when others are greedy," we see a lot of bullishness, above average bullishness in the market today, and we see below average bearishness. So another reason potentially to be cautious, particularly in large U.S. technology companies. When we look across different high-level indicators of economic health and market health, we see the labor market in relatively good shape, which we'll talk about in a moment, but showing some signs of deterioration. Earnings are relatively flat year over year. Corporate earnings relatively flat year over year in aggregate. Household sentiment has been low for quite some time because of inflationary pressures, but we're seeing that start to rise. And inflation itself has begun to come down, but still potentially more work to do, as we see, for example, higher energy prices and higher prices at the gas pump may may create more inflationary pressures and lead to lower household sentiment again. The U.S. Federal Reserve has been tightening interest rates in an effort to try to control inflation. They're trying to slow economic growth and slow borrowing and spending. At the same time, the federal government has remained very stimulative in the form of the Inflation Reduction Act, seeking to bring seeking to bring the production of electric vehicles and renewable energy back to the United States, as well as the CHIPS Act, seeking to bring computer chip or semiconductor manufacturing back to the United States. So this is positive for sure, that we're bringing more manufacturing and jobs back to the U.S. And should pay dividends for the economy in the future. So one area of optimism, but could create more inflationary pressures and lead to higher interest rates for longer. When we look at the labor market, we see a record number of employed Americans every month since last summer, which is positive. We are starting to see employers pull back on job openings. We're starting to see the number of job openings, which is elevated, but we're starting to see employers pull those back and not repost them. The unemployment rate is still very low, but starting to rise as well. So just an area of caution with respect to the labor market, still in very good shape, but showing some signs of deterioration. Household finances are also in very good shape. So many folks refinanced their mortgage during COVID, and household debt service is very low relative to household incomes. However, credit card spending is up and credit card balances are up. So potentially some of the household spending that helped the economy stave off a recession in 2023 was financed by spending on credit, which will have to be repaid at some point and lead to lower future spending. The Federal Reserve has been raising interest rates at a very aggressive clip, the most aggressive clip in the last 40 years, which has a chilling effect on the economy. It slows down borrowing and spending, which is by design. They're seeking to slow down borrowing and spending to control inflation. This is bad for the economy in general, but good for savers who can now earn 5% plus on deposits and short-term investments, as well as things like dividend stocks, which we touched on. The U.S. Manufacturing industry may be going through a renaissance right now. As we said, the federal government is incentivizing the production of electric vehicles and renewable energy here in the United States, as well as the CHIPS Act is incentivizing the production of computer chips or semiconductors in the United States. So we're seeing a big boom in U.S. manufacturing construction spending, so building facilities to produce more things here in the United States, which should lead to jobs and future kind of economic dividends as this trend continues to take hold. On the valuation side, we are seeing higher interest rates for fixed income investments again, which is a good thing. We're seeing on cash and short-term government bonds, we're seeing north of 5% rates. However, long-term bonds are still in the low fours, and we think there's a potential for these to continue to move higher. So when interest rates move higher, particularly for longer duration investments, that tends to lead to a lower price. So we're still a little bit cautious on long duration bonds, as we think there's the potential for yields to continue to move higher and prices to continue to move lower. We often get asked, is the market cheap or expensive? When we talk about the market, it's typically referring to the S&P 500. The S&P 500 is trading at about 21 times next year's future earnings, which is on the expensive side. However, when you normalize and you remove some of those large companies like the Apples and the Amazons of the world, you actually get a much more average value relative to history over the last 10 years or so. So we think that when you kind of normalize for the effect of large technology companies, there is value in the market today in the S&P 500, as well as within small U.S. companies, which are trading at a 50% discount to their large cap peers, which we think is very attractive. Similarly, foreign companies are trading at about a 50% discount to their large cap peers, which we think is quite interesting. So to summarize, the market has recovered in 2023 as fears of a recession were were driving the market lower in 2022 ultimately never materialized, and the market has begun to recover in 2023. Investors have turned very bullish, particularly on large U.S. technology companies, so that's a reason for caution from our perspective. We did not expect a recession in 2023 as a firm, and we were positioned for a recovery. We now believe that the 2024 recession is very possible, and we're positioning portfolios accordingly. We like areas like dividend stocks, small U.S. companies, and foreign companies, which may offer value and relative value and potentially could be more defensive in a recessionary environment. And going forward, we think that higher yields on things like dividend stocks and bonds provide investors with income and liquidity to wait for future opportunities when and if they materialize. We, again, expect that later this year or in early 2024, there may be increased volatility in lots of parts of the market as the potential for a recession becomes more salient in investors' minds. Thank you for listening to this webcast, and we stand at the ready to meet with you to discuss these ideas and to discuss your portfolio. Thank you.